So let's look at ordinary equity. Now, ordinary equity, or the common stock of a business, is analysed in a very similar way to how we approach debt. Just like we covered in our debt video, it's easiest if we look at the financial statement impacts of ordinary equity to understand how we can break the financial statement impacts into two sets. So when we look at the financial statement impacts of ordinary equity within a three-way financial model, these can be broken into two sets: the ordinary equity balances and the dividends. The first set, being the ordinary equity balances, are what we can refer to as the return of capital. As the financial statements are presented from the perspective of the shareholders, we refer to this as the return of capital, as when a business buys back shares, this is the return of capital to the shareholders. The second set of impacts, the dividends, these are what we can refer to as the return on capital. This is where the business paying dividends is the return or compensation to the shareholders for providing the capital to the business. Now, if we look at the return of capital, unlike debt, where raising debt does not affect the net assets of a business, the ordinary equity balances does affect the net assets of a business. In this case, we have a net equity raising, and therefore the increase in ordinary equity increases the net assets of the business. Whereas, when we look at the return on capital, as the financial statements are from the perspective of shareholders, dividends are not an expense to the business and are not reported as an expense, which would decrease profit. Instead, these are reported as a financing cash flow, which decreases cash and net assets, and our dividends declared also reduces our retained profits and total equity on the balance sheet. It's important to note too that dividends decrease total equity and the net assets of a business when they're declared, not when they're paid in cash. Any dividends that are not fully paid in cash in the period in which they are declared, we then adjust with the dividends payable balance on the current liability section of the balance sheet. So again, we have the two sets of impacts when looking at ordinary equity within a three-way financial model. Currently on screen, we have our return on capital, and we also have our equity balances themselves, which are return of capital. Now, hopping into our example, when you first bring in your historical ordinary equity balances into your financial model from your accounting package, this is brought into your historical balance sheet and into your ordinary equity section at the bottom. You can see here that we have our ordinary equity balance with the historical balances on the right-hand side of the sheet. And if we scroll across our time series until we get to our last historical month of June 22, we can see that we have a closing balance of 0.1. Now, when we forecast your ordinary equity, this is handled just like debt on the capital sheet, and our ordinary equity analysis is located below our debt analysis. Now again, just like debt, at the top of our analysis we have our ordinary equity balances, which is our return of capital. You can see that we have our raisings and buybacks, and underneath this we then have our dividends calculations, which is our return on capital. Firstly, looking at our equity raisings and buybacks, if we look at the December 22 month, if we want to include an equity raising of say $100 and enter our assumption, we can then see that we have our opening balance of 0.1 increasing by 100, giving us our closing balance of 100.1 at the end of December 22. Then if we look at our return on capital, we can then see that we have our dividends calculation. Now this is where ordinary equity differs to debt. This is because we can specify the periodicity in which we assess our dividends and the methodology in which we want to use to calculate the value. Currently we have semi-annual dividend assessment periods, and the mechanism that we're using is set to a 50% of NPAT payout. Again, looking at December 22, we can see that this is one of our semi-annual assessment period months. Now with the mechanism of our dividend set to 50% of net profit after tax for the 6-month period, if we scroll below here into our dividends determination calculation, we can see that we're pulling in our net profit after tax from our income statement here. In the month of December 22, we have a net profit after tax of 119.7. Now as we have a semi-annual assessment period, we must take the sum of the 6 months net profit after tax, which is currently 515.6. As we can see, this is present in our net profit after tax for dividends determination. Using our 50% payout mechanism, we can then see below that our dividends declared equals 257.8 for the 6-month period ending in December 22. This dividend declared is our return on capital, and we can see that we have our declaration and a 1-month delay in our payment, with the dividends then being paid out in the following month of January 23. The financial statement impacts are summarized at the bottom of our ordinary equity analysis. We can firstly see that we have our ordinary equity balances, our return of capital, showing our opening balance of 0.1 with a raising of 100, giving us our closing balance of 100.1 at the end of December 22. Similarly, when we look at our dividends or our return on capital, we have our dividend declaration of 257.8 not being paid within the month of December 22, leaving us with a closing dividends payable balance of 257.8. Then, 1 month later, we then have the payment of this dividend, leaving us with a closing dividends payable balance of 0. If we want to see these movements hitting the financial statements within our model, we can head back to our table of contents and activate our financial statements. Firstly, looking at our return of capital, scrolling to the bottom of our balance sheet, we can then see our ordinary equity balance. If we scroll across our time series until we get to December 22, we can see in December 22, we have a closing equity balance of 100.1. And if we scroll down into our cash flow statement and look at our ordinary equity raisings, we can see the $100 of equity injection into the business. Then if we want to see our return on capital, if we scroll back up to our balance sheet and expand our retained profit section, we can see that we have our dividends declared in the month of December 22 of 257.8. Note that in this month, the dividend declaration decreases our retained profits and our total equity of the business. As the dividend has been declared and not paid, we then adjust for this within our current liability section, and we can see that we have a dividends payable balance matching of 257.8. Then if we scroll down to our cash flow statement and look at our ordinary equity dividends paid, we can then see in the month of January 2023, we have the payment of 257.8. And if we scroll back up to our balance sheet, we can then see that we no longer have a dividend payable on our current liabilities. To recap, when you were looking at the financial statement impacts of ordinary equity within a three-way financial model, there are two main sets of impacts. The first being the ordinary equity balances themselves, which we refer to as a return of capital. Changes in our ordinary equity balances change the net assets and total equity of the business. The other set of financial statement impacts are our dividends, which we refer to as a return on capital. When dividends are declared, they reduce the retained profit and total equity of a business, and are also contained within the financing section of the cash flow statement. As dividends declared decrease the total equity of a business as soon as they are declared, not when they are paid, any outstanding dividends which have not yet been paid at the end of the period are then adjusted for within the dividends payable within the current liability section, ensuring that our balance sheet is always balanced. So whenever we're analysing ordinary equity within a three-way financial model, we can always break down the financial statement impacts into the two sets of ordinary equity balances and dividends, those being our return of capital and return on capital, just like how we approach debt.